All right, in A4 we talked about some other types of depreciation, other ways that we can depreciate an asset that we have. Before this we just used the straight line depreciation. Now we're going to talk about a couple other ones. First is double declining balance method of depreciation. It's very similar to straight line, except in this one we do not take into account the salvage value. Okay, so there's no salvage value in this guy. In double declining, we take the total depreciation expense and we use 100% of the total amount that we can depreciate, okay? Instead of, in straight line, we use the dollar amount and we divided it by the useful life, and this gave us a dollar figure here. Now we're going to use 100% of that amount, so use the percentage. We divide it by the useful life, in this case 5 years, which gives us basically our straight line of 20% each year. For double declining, the last step is we double that amount, so we just take it times 2. Now we have a 40% rate that we can depreciate each year. It's not a certain dollar amount, it's 40% of the total value, of the book value. Okay? So each year, 40%. And remember, we can't depreciate past the salvage value. We don't take salvage value into account when we are coming up with our depreciation, but there still is a salvage value. In this case, it's the same example in the book on 242. The salvage value is 175, so we can't depreciate past the 175 mark. For example, here if we had an asset worth $1,000, we don't care about that at the moment. We're just going to use 100% of that value. Its useful life is 4 years, so we're going to divide that by 4 years. Give us 25%. This is basically our straight line right here. We take that times 2 to get our double declining balance. So we're going to depreciate 50% of this value each year. Alright, so in year 1, we have basically $1,000 minus 50%. That's going to be $500. So in year 1, we're going to depreciate $500, and we're going to have a book value then of $500. Okay, so depreciation. This is our beginning book value. Year 2, beginning book value is $500. We're still going to depreciate 50%. In this case, that's $250. Okay, so our depreciation is $250. Our ending book value is $250. In year 3, $250. We're going to depreciate 50%. In this case, that's going to be $125. Our book value is down to $125. We have year 4. Beginning book value is $125. We're depreciating 50%. In this case, that is $6,250. Our ending book value is $6,250. Okay, 4 years of depreciation, 50% each year. We haven't gone past our salvage value, $50, so we're good to go. So that's an example of the double declining balance. The next one is the sum of the year's digits method. This one's a little odd, but once we learn it, it's not that difficult. It's just a little different. For this type of depreciation, we do take the salvage value into account when we calculate it. So we start with the cost of the asset. In this case, we have a $2,000 asset. Salvage value is $175. We have a useful life of $5. The idea behind the sum of the year's digits is we start with the useful life. In this case, we have a 5-year useful life. So what we need to do is we take, there's 5 years, so year 1 plus year 2 plus year 3 plus year 4 plus year 5. If we add these up, it should give us the number 15. What we're going to do is we're going to use this 15th in a fraction that we're going to use to calculate our depreciation for each year. And we do it backwards. So in year one, let's go over here. In year one, we're going to depreciate 5/15 of our value. In year two, we're going to depreciate 4/15. Year three, 3/15. Year two, 2/15. Oh, I'm sorry, this is year four. Year four is 2/15, and year five, we're going to depreciate 1/15 of the value. Okay? So, if we look on the chart here, similar to what we've done here, instead of in straight line, it was a certain dollar amount every year. In double declining, it was the same percentage every year. This time it's going to change each year. So 5/15 of the depreciation total in year one, and we go down just like that. So in year one, the total cost of the asset was $2,000, but we say there's a salvage value of $175. So the amount we can depreciate is $1,825, and we want to multiply that by 5/15, and that'll give us a year one depreciation of $608.33. Okay, that becomes our beginning book value for the next year. What's different about this method is that we're not going to take the depreciation, we're not going to figure the depreciation based on the beginning book value each year. Okay, each year we're going to take the fraction times 1825 times the total depreciation amount. Okay, so in year one we're depreciating 5/15 of 1825. That gives us $608.33. The book value for year two is $1391, but we're not so concerned with that right now. If someone asks us on our books if we need to check, that's our book value. For depreciation for year two, we're going to depreciate 4/15 of 1825. Gives us $486. Okay. In year three, we're going to depreciate 3/15 of 1825. In year four, we're going to depreciate 2/15 of 1825. And in year five, we're going to depreciate 1/15 of 1825. Okay. So our calculation always comes off of the 1825. Okay. In our books, these are the values of our assets. For depreciation's sake, we're going with the total depreciation amount for each year. And then after our useful life, the last depreciation amount should equal our salvage value right there. So we don't have to worry about going past it. They'll equal out. So on this one, for year two, doesn't matter what our book value is, because in year two, we're still doing 1825 times 4/15. Okay, and that gives us 486.67. So that's year one, that's year two, year three, still 1825 times 3/15 gives us 365. Okay, and then so on for year four and year five. The third type is the production unit method of depreciation. In this case, we are worried not so much about the useful life in years, but the useful life in how much use we can get out of that item. A good example is a vehicle. We're going to drive this vehicle for 90,000 miles. Okay. Value to us, the original cost was $18,200. We say it has a salvage value of $2,000. So the total depreciation that we can take on this is going to be $16,200. We decide we're going to drive this truck for 90,000 miles, then we're done with it. That's what we expect to get out of it. Okay? So that's where we're going to calculate our depreciation. We'll depreciate it by the amount that we use, not necessarily the amount of time. So for example, the original cost of this truck was the $18,200. We're saying it has a salvage value of $2,000. So the amount that we can depreciate is going to be $16,200. Okay? If we say that it's good for 90,000 miles, we'll divide that by 90,000. Whereas before, we might divide this by 3 years, 5 years, etc. Okay? This time we're going to divide it by the actual use we're going to get out of it. We do the calculation there. It gives us 0.18. Okay, we're talking about dollars and miles. Do this calculation. Basically what it's telling us is that we can depreciate 18 cents, 0.18, 18 cents per mile. Okay? So now instead of depreciating, a percentage each year or a dollar amount each year, we're going to depreciate 18 cents for every mile that we use this item. In the production unit method here, we're going to start with the beginning book value. So in year one, it says that we have driven 9,000 miles. Okay? We're depreciating 18 cents each mile, so we can take 9,000 times 0.18. It's going to give us 1620. We can depreciate in year one $1,620. So that will give us an ending book value $16,580. Year two, we have 16,580 is our beginning book value. In year two, we drove 23,000 miles. Take that times 0.18. We can depreciate in year two 4,140. 16,580 minus 4,140, $12,440 is our ending book value in year two. Year three says that we drove 25,000 miles times 0.18 gives us depreciation for this year of $4,500. Subtract that from the book value, $7,940. Okay? So that's how we do the production unit. Instead of depreciating it over time, we depreciate it based on the amount that we've used of it. The third type of depreciation they talk about is not one that is used by businesses in their day-to-day operations for their own depreciation. It's the MACRS. It's an acronym. It stands for Modified Accelerated Cost Recovery System. It's in your book on 246. What this one is used for, why we even have to learn it, is that this is what the government requires us to use to pay taxes. Okay? As a company, we wouldn't use it in our own books on a day-to-day basis, but the government will require us to use it for tax purposes. Okay? It's fairly straightforward. The government is going to tell you what property class you belong to. So there's several different property classes. The two most common ones are 5-year and 7-year. The 5-year one includes cars, trucks, computers, etc. 7-year, office furniture and expenses. Okay? And the government will give us a table very similar to this. They'll tell you what category your equipment falls under, and you just simply do the math. Okay? You don't have to decide what percentages to use. Okay? The only thing that's weird about this is that, for example, what they're showing us is a 5-year. If you see, the property class is 5-year, but there's 6 years over here. What they do is the government assumes, right or wrong, they assume that you never buy anything on January 1 of that year and start using it. They're assuming you use it in the middle of the year always. So in year 1, it's going to be a partial. And then you would have year 2, 3, 4, 5, and then year 6 would also be partial. So you have full year, full year, full year, full year, that's 4, plus part and part, that gives you 5 years. Okay? So they spread the 5 years out, part of the first year, part of the 6th year. Okay? Excuse me. But this is the chart that would be used for the 5-year. In the makers, the MACRS, you do not take into account the salvage value. So you just simply take the original cost. So for example, this example is $2,000 printer that we have, and it's in the 5-year class. So we're going to look in our books. The government will give us this chart that says this is what you use for 5-year. Okay, cool. Year 1, the depreciation is 20%. If we do the math, 20% of 200 is 400. Year 2, it tells us our depreciation is 32%. 32% of 200, excuse me, 32% of 2,000 is 640. Year 3, 19.2%. 19.2% of 380, excuse me, of 2,000 is 384, and so on. Okay, so we go down the list. Really, all you need to know for this one is that the government's going to tell you what class you fall into. They're going to give you this chart. You just simply take the original cost times the depreciation rate, and that's going to give you the depreciation for each year. Okay, so salvage value, again, not taken into account on this one. Last but not least is depletion. Depletion is similar to the production unit method. We depreciate by how much we use up. Depletion basically is usually referred to when we're talking about a natural resource. Coal, lumber, trees, oil, something like that, some type of natural resource. But we depreciate by how much of it we use, not by the amount of time. Okay? If we had a forest and it sat there for 10 years, we wouldn't use any trees. More would actually grow, so we wouldn't lose any value in that. As we start chopping down the trees to use them to create 2x4s, whatever we're doing, then we start to lose value in that asset. The example we have in the book on page 247 says that this company owns land on which coal is located. Okay, so they own some land and they found there's coal underground, so they're mining the coal. They paid $100,000, or the value for the land originally was $100,000, and they assume they're going to get about 50,000 tons of recoverable coal. Okay, so they don't know exactly, but they're assuming they're going to get 50,000 tons of coal. Just like with the truck, we assumed we're going to drive it for 90,000 miles. Useful life of a printer, we assume, is going to be 5 years. Okay, that's how we figure. We don't know exactly. Okay, so 50,000 tons of recoverable coal is what we're going to take out of there. The estimated value of the land after we take out the coal is going to be $12,250. So that's the salvage value of this land after we're done taking the coal. Okay, so if we do the math here, original cost $100,000, subtract out the salvage value, gives us $87,750. We assume we're going to get 50,000 tons of coal, so we divide these two, which tells us that our depletion rate, not depreciation rate, but depletion rate is going to be 1.755. Basically, this means that every ton of coal, every one of these 50,000 we take away from this land, depletes its value by $1.75, 75.5 cents. Okay? So our original value was $100,000, salvage value $12,250. We're basically going to use up, we're going to deplete $87,750 worth of this asset. Okay, that's how much we're going to use up. And we're going to divide that by how much we're going to get out of there. So 50,000 tons of coal gives us 1.755. So we're going to use up $87,000 worth, divide that over each ton of coal, $1.75 per ton of coal. That's our depletion rate. So in year one, it says that we recovered 6,000 tons of coal. So 6,000 times our depletion rate of 1.755 gives us $10,530 of depletion for year one. So that's going to give us a ending book value of $89,470. In year two, we're using up 12,000 times our 1.755. Depletion in year two is going to be $21,060. And this is coming from the book value, not the original cost, but the book value. So our ending book value for year one became our beginning book value for year two. So 89,470 minus 21,060 gives us an ending book value 68,410 for year two. Year 3, we used up 13,000 times 1.755. Depletion 22,815. Ending book value 45,595 for year 3. So year 3 ending book value becomes year 4 beginning, so on and so forth. Okay? So for depletion, we base it on the amount that we use up.